Welcome to our journey through the intricate world of tax optimization. Over the next 3 hours, we'll explore complex strategies designed to maximize financial efficiency. As we progress, the concepts will become increasingly sophisticated, offering a comprehensive view of modern tax planning. Let this exploration of fiscal intricacies gently guide you into a state of relaxation and contemplation. As we delve into the intricate world of tax optimization, we begin our journey with the fundamental concept of income shifting. This strategy, rooted in the very fabric of tax policy, has been a cornerstone of financial planning for generations. At its core, income shifting suggests that by strategically allocating income across different tax brackets or entities, one can potentially reduce their overall tax burden. To truly grasp the essence of income shifting, let's first explore its historical context. The concept emerged in the early 20th century as tax systems became more complex and progressive. Imagine, if you will, a river of income flowing through various channels, each representing different tax rates. The goal of income shifting is to guide this river along the paths of least resistance, or in this case, lower tax rates. The basic principles of income shifting are intricately tied to the structure of tax brackets. In most progressive tax systems, income is taxed at increasing rates as it reaches higher thresholds. By understanding these thresholds, one can potentially distribute income in a way that maximizes the use of lower tax brackets. This is not unlike a skilled gardener who carefully directs water to different areas of a garden, ensuring optimal growth while conserving resources. Fundamental timing strategies play a crucial role in income shifting. Consider the ebb and flow of tides. Just as the moon's gravitational pull affects the timing of high and low tides, so too can the timing of income recognition impact your tax liability. By carefully controlling when income is received or expenses are incurred, it's possible to smooth out tax liabilities over multiple years, potentially reducing the overall tax burden. As we dive deeper into the concept, we must consider the various methods of income characterization. The tax code treats different types of income, such as ordinary income, capital gains, and passive income, in distinct ways. Understanding these distinctions is like learning the different dialects of a language. Each has its own nuances and applications in the world of tax planning. Family attribution rules add another layer of complexity to income shifting strategies. These rules are designed to prevent abuse of the tax system through artificial income splitting among family members. Imagine a family as a single economic unit, with the tax authorities drawing a circle around it. The challenge lies in finding legitimate ways to allocate income within this circle while respecting the boundaries set by tax regulations. Basic income splitting techniques often involve gifting strategies or the use of family trusts. These methods can be likened to distributing weight evenly across a structure to maintain balance. By carefully allocating income-producing assets among family members, it may be possible to take advantage of lower tax brackets and personal exemptions, ultimately reducing the family's overall tax liability. As we progress to more advanced income timing strategies, we enter a realm of sophisticated financial choreography. This might involve accelerating or deferring income recognition, much like a conductor controlling the tempo of an orchestra. For instance, a business owner might defer invoicing until the next tax year to push income into a potentially lower tax bracket, or accelerate deductible expenses to offset current year income. Cross-border considerations add yet another dimension to income shifting. In our increasingly globalized world, income can flow across international boundaries, each with its own tax implications. This is akin to navigating a complex network of canals, each with its own locks and water levels. Understanding international tax treaties, foreign tax credits, and the concept of tax residency becomes crucial in optimizing global income streams. The implications of entity structure on income shifting cannot be overstated. Different business entities, such as sole proprietorships, partnerships, corporations, and LLCs, each have unique tax characteristics. Choosing the right entity structure is like selecting the appropriate vehicle for a journey. The choice can significantly impact the efficiency and effectiveness of your tax strategy. As we contemplate the deeper implications of income shifting, we must consider its economic impact. On a macro level, income shifting strategies can influence capital allocation and investment decisions. It's a delicate balance. While individuals and businesses seek to minimize their tax burdens, governments rely on tax revenue to fund public services and infrastructure. Social policy considerations also come into play when examining income shifting. The tax code is often used as a tool to encourage certain behaviors or support specific groups. For instance, preferential tax treatment for certain types of investments or deductions for charitable giving can be seen as a form of social engineering through fiscal policy. Looking towards the future, we can anticipate evolving regulatory trends in the realm of income shifting. As tax authorities become more sophisticated in their tracking and analysis capabilities, we may see increased scrutiny of complex income shifting strategies. This could lead to new regulations aimed at closing perceived loopholes or a shift towards simpler, more transparent tax systems. The art of income shifting, much like the constant flow of a river, continues to evolve and adapt to the changing landscape of tax policy. As we transition to our next topic on business entity structures, remember that income shifting is but one tributary in the vast delta of tax optimization strategies. Each concept we explore builds upon the last, creating a comprehensive understanding of the intricate world of tax planning. As we prepare to delve into the realm of business entity structures, Consider how the principles of income shifting we've just explored might apply in the context of different organizational forms. The complexity of our journey is about to increase, but with each step, we gain a deeper appreciation for the nuanced interplay between financial strategy and tax policy. As we delve deeper into the intricate world of tax optimization, we now turn our attention to the fascinating realm of business entity structures. This complex topic forms the backbone of many advanced tax strategies, influencing everything from income allocation to liability protection. Let's embark on this journey through the labyrinth of corporate structures and their tax implications. At its core, the choice of business entity structure is a delicate balance between tax efficiency, legal protection, and operational flexibility. Each structure comes with its own set of rules, advantages, and potential pitfalls. To truly understand this landscape, we must first explore the fundamental types of business entities and their tax treatment. Let's begin with the most basic form, the sole proprietorship. In this structure, there is no legal distinction between the business and its owner. From a tax perspective, all business income is reported on the owner's personal tax return, subject to both income tax and self-employment tax. While this simplicity can be appealing, it also means the owner bears full personal liability for all business debts and obligations. Moving up in complexity, we encounter partnerships. These can be general partnerships, where all partners share in management and liability, or limited partnerships, where some partners have limited liability, but also limited control. Partnerships are considered pass-through entities for tax purposes, meaning the business itself doesn't pay taxes. Instead, profits and losses are passed through to the partners, who report their share on their individual tax returns. This pass-through nature can offer significant tax advantages, as it avoids the double taxation often associated with corporations. However, it also means partners may be taxed on profits they haven't actually received, a phenomenon known as phantom income. This can create cash flow challenges for unwary business owners. Next, we come to the limited liability company, or LLC. This hybrid entity combines the liability protection of a corporation with the tax flexibility of a partnership. By default, single-member LLCs are treated as disregarded entities for tax purposes, while multi-member LLCs are taxed as partnerships. However, LLCs have the unique ability to elect their tax treatment, potentially being taxed as corporations, if that proves more advantageous. This flexibility is a powerful tool in the tax planner's arsenal. For instance, an LLC might choose to be taxed as an S corporation to potentially reduce self-employment taxes on the owner's income. This strategy, known as the S Corp loophole, involves paying the owner a reasonable salary subject to employment taxes, with the remaining profits distributed as dividends, which aren't subject to self-employment tax. Speaking of corporations, Let's examine the two primary types, C corporations and S corporations. C corporations are separate taxable entities, meaning the company itself pays taxes on its profits. When these profits are then distributed to shareholders as dividends, they're taxed again at the individual level. This double taxation is often cited as a disadvantage of C corporations. However, C corporations also offer unique tax planning opportunities. They can deduct certain expenses that other entities cannot, such as full health insurance premiums for employees. They also have more flexibility in choosing a tax year and can more easily retain earnings for future growth. For businesses planning to go public or seek venture capital funding, the C corporation structure is often preferred. S corporations, on the other hand, are pass-through entities like partnerships. They avoid double taxation, as all corporate income, losses, deductions, and credits are passed through to shareholders. However, S corporations come with strict rules. They're limited to 100 shareholders, can only have one class of stock, and all shareholders must be U.S. citizens or residents. The choice between these entity types can have profound implications for a business's tax liability and overall financial health. For example, consider a hypothetical technology startup. In its early years, when it's investing heavily in research and development and expecting losses, a pass-through entity like an LLC might be advantageous. The losses can offset the owner's other income, reducing their overall tax burden. However, as the company becomes profitable and seeks outside investment, converting to a C corporation might make more sense. This could allow for multiple classes of stock to attract investors, and the corporate structure would be more familiar to venture capitalists and potential acquirers. But the complexity doesn't end with choosing an initial structure. Advanced tax planning often involves using multiple entities in concert. For instance, a holding company structure might be employed, where a parent company owns separate LLCs for different aspects of the business. This can provide asset protection and potentially create tax-advantaged income streams. Another advanced strategy is the use of S corporation blocker entities to manage the tax implications of foreign ownership in partnerships. By inserting an S corporation between a foreign investor and a partnership, it's possible to convert effectively connected income into dividend income, potentially reducing the foreign investor's U.S. tax liability. The choice of entity structure also has significant implications for international tax planning. For businesses operating across borders, the interplay between different countries' tax systems can create both pitfalls and opportunities. For example, certain entities might be treated differently for tax purposes in different jurisdictions, a situation known as a hybrid mismatch. While tax authorities are increasingly cracking down on aggressive uses of these mismatches, they remain an important consideration in international tax planning. As we ponder these complex structures and strategies, it's worth considering the broader implications. The evolution of business entity structures reflects the ongoing dance between businesses seeking to minimize their tax burdens and governments trying to ensure fair contribution to public coffers. This dynamic has led to increasingly sophisticated entity structures and equally complex tax regulations. From an economic perspective, the availability of different entity structures can promote entrepreneurship and investment by allowing businesses to optimize their legal and tax positions. However, critics argue that complex corporate structures can also facilitate tax avoidance and erode the tax base, potentially shifting the tax burden to individual taxpayers. Looking to the future, we can expect continued evolution in this space. The rise of digital businesses that don't fit neatly into traditional entity categories is already challenging existing tax frameworks. Meanwhile, efforts towards global tax harmonization, such as the OECD's base erosion and profit shifting BEPS project, may reshape the international tax landscape. As we conclude our exploration of business entity structures, we're left with a profound appreciation for their complexity and importance in tax planning. From the humble sole proprietorship to intricate international holding company structures, each choice carries significant implications for a business's tax liability, legal protection, and operational flexibility. In our next segment, we'll build upon this foundation as we delve into investment tax strategies, exploring how the choice of entity structure interacts with investment decisions to create a comprehensive tax optimization framework. But for now, let the complexities of business structures gently fade into the background of your consciousness, allowing your mind to drift towards the equally intricate world of investment taxation that awaits us. As we delve deeper into the realm of tax optimization, we now turn our attention to investment tax strategies. This complex and nuanced area of financial planning offers a wealth of opportunities for the savvy investor to maximize returns while minimizing tax liabilities. Let's embark on this journey through the intricate landscape of investment taxation, where each decision can have profound implications on your financial future. To begin, let's consider the fundamental concept of capital gains optimization. When you sell an investment for more than you paid for it, you realize a capital gain. The tax treatment of these gains can vary significantly depending on how long you've held the asset. Short-term capital gains, those from investments held for 1 year or less, are typically taxed at your ordinary income tax rate. However, long-term capital gains from investments held for more than a year often benefit from preferential tax rates. Imagine, if you will, 2 identical investments, each purchased for $10,000 and sold for $15,000. The first, held for 11 months, might be subject to a tax rate of 32% if you're in a high tax bracket, resulting in a tax bill of $1,600. The second, held for 13 months, could be taxed at the long-term capital gains rate of 15%, leading to a tax of only $750. This simple timing decision could save you $850 in taxes. But the story doesn't end there. The interplay between capital gains and your overall tax situation can be complex. For instance, realizing too many capital gains in a single year could push you into a higher tax bracket, potentially affecting other areas of your financial life, such as the taxation of your Social Security benefits or your eligibility for certain deductions and credits. Now, let's turn our attention to dividend tax treatment. Dividends, those regular payments some companies make to their shareholders, come in two flavors: qualified and non-qualified. Qualified dividends, which must meet certain holding period requirements, are taxed at the same preferential rates as long-term capital gains. Non-qualified dividends, on the other hand, are taxed as ordinary income. Consider a scenario where you receive $10,000 in dividend income. If these are all qualified dividends, and you're in the 15% long-term capital gains tax bracket, you'd owe $1,500 in taxes. However, if they're non-qualified and you're in the 32% ordinary income tax bracket, your tax bill would jump to $3,200. This stark difference underscores the importance of understanding the nature of your dividend income and structuring your portfolio accordingly. As we progress deeper into the realm of investment tax strategies, we encounter the concept of tax-efficient asset location. This strategy involves placing your investments in accounts that will minimize their tax impact. For instance, high-yield bonds, which generate significant taxable income, might be better suited for tax-advantaged accounts like IRAs or 401(k)s. Meanwhile, growth stocks that you plan to hold for the long term could be more appropriate for taxable accounts, where they can benefit from long-term capital gains rates and the potential for tax loss harvesting. Speaking of tax loss harvesting, this powerful technique involves selling investments that have declined in value to realize a loss, which can then be used to offset capital gains or even a portion of your ordinary income. However, it's crucial to navigate the wash sale rule, which prohibits claiming a loss on a security if you buy the same or a substantially identical security within 30 days before or after the sale. Consider an investor who bought 100 shares of stock A for $10,000, which has since declined to $8,000. By selling these shares and realizing a $2,000 loss, they could offset $2,000 of capital gains from other investments, potentially saving hundreds in taxes. However, if they repurchase stock A within 30 days, the wash sale rule would disallow the loss. As we delve even deeper, we encounter more advanced strategies like tax-efficient withdrawal sequencing in retirement. This involves carefully planning which accounts to draw from and in what order to minimize your overall tax burden throughout retirement. For instance, it might be advantageous to draw from taxable accounts first, allowing tax-advantaged accounts more time to grow tax-free. Another sophisticated strategy is the use of exchange-traded funds, ETFs, for their potential tax advantages over mutual funds. Due to their unique structure, ETFs often generate fewer capital gains distributions, making them a potentially more tax-efficient option for many investors. As we near the end of our exploration of investment tax strategies, it's crucial to consider the philosophical implications of these techniques. On one hand, strategic tax planning allows individuals to retain more of their hard-earned wealth, potentially leading to greater financial security and the ability to pursue personal and philanthropic goals. On the other hand, the complexity of these strategies can create disparities between those who have the knowledge and resources to implement them and those who don't. Moreover, as investors become increasingly tax-savvy, it raises questions about the effectiveness of using the tax code to incentivize certain behaviors. If sophisticated planning can significantly reduce tax liabilities, does this undermine the original intent of these tax policies? Looking to the future, we must consider how evolving technology and potential changes in tax policy might reshape the landscape of investment tax planning. The rise of robo-advisors and AI-driven tax optimization tools could democratize access to sophisticated strategies. Meanwhile, proposals for wealth taxes, changes to capital gains rates, or alterations to step-up basis rules could dramatically shift the playing field. As we conclude our exploration of investment tax strategies, we're left with a profound appreciation for the intricate dance between investment decisions and tax implications. Each choice, from the type of account you use to the timing of your trades, can have far-reaching consequences on your financial future. As we transition to our next topic, real estate tax benefits, keep in mind how these investment strategies might interplay with the unique tax advantages offered by property ownership. The world of tax optimization is truly a tapestry of interconnected strategies, each thread weaving into the next to create a comprehensive picture of financial efficiency. As we delve deeper into the world of tax optimization, we arrive at a particularly lucrative area: real estate tax benefits. This realm of taxation offers a myriad of opportunities for the savvy investor to maximize returns while minimizing tax burdens. Let's explore the intricate landscape of real estate taxation, where property becomes not just a physical asset, but a powerful tool for financial strategy. At its core, real estate tax benefits revolve around the concept of property as a depreciating asset. While this might seem counterintuitive, given that real estate often appreciates in value over time, the tax code recognizes the gradual wear and tear on buildings and structures. This recognition forms the basis of one of the most powerful tools in real estate taxation: depreciation. Depreciation allows property owners to deduct a portion of their property's value each year as a non-cash expense. For residential properties, this depreciation is typically spread over 27.5 years, while commercial properties are depreciated over 39 years. This means that even if your property is generating positive cash flow, you might show a paper loss for tax purposes, effectively shielding some of your income from taxation. But depreciation is just the beginning. Let's delve into another fundamental strategy in real estate taxation: the 1031 exchange. Named after Section 1030, one of the Internal Revenue Code, this provision allows investors to defer capital gains taxes by exchanging one investment property for another of like kind. The power of this strategy lies in its ability to preserve capital that would otherwise be lost to taxes, allowing for continued investment and growth. Imagine you've owned a small apartment building for several years, and it has appreciated significantly. If you were to sell it outright, you'd be facing a substantial capital gains tax. However, by utilizing a 1031 exchange, you could sell that property and use the proceeds to purchase a larger apartment complex or even a commercial building, all while deferring the capital gains tax. This strategy allows you to essentially trade up your investments without the immediate tax consequences, potentially snowballing your real estate portfolio over time. It's important to note that 1031 exchanges come with strict rules and timelines. You must identify potential replacement properties within 45 days of selling your relinquished property, and you must close on the new property within 180 days. These deadlines are absolute, with no extensions granted even for weekends or holidays. The complexity of these rules underscores the importance of working with experienced professionals when executing such strategies. Moving beyond these foundational concepts, let's explore a more advanced strategy: cost segregation analysis. This technique involves breaking down the components of a property to accelerate depreciation on certain elements. While the building structure itself might be depreciated over 27.5 or 39 years, many components within the building can be classified as personal property or land improvements, which have much shorter depreciation periods. For instance, carpeting, certain lighting fixtures, or landscaping might be depreciated over 5, 7, or 15 years. By identifying and reclassifying these components, a property owner can front-load depreciation deductions, significantly reducing taxable income in the early years of property ownership. This strategy can be particularly powerful when applied to newly acquired properties or after substantial renovations. The benefits of cost segregation can be substantial. In some cases, it might allow a property owner to depreciate 20% to 30% of a building's cost over a 5 to 7 year period, rather than the standard 27.5 or 39 years. This acceleration of deductions can result in significant tax savings, improving cash flow, and potentially freeing up capital for further investments. As we delve deeper into the realm of real estate tax benefits, it's crucial to consider the interplay between these strategies and the broader tax landscape. For instance, the Tax Cuts and Jobs Act of 2017 introduced new limitations on the deductibility of state and local taxes, including property taxes. This change has had varying impacts on real estate investors, depending on their location and the nature of their holdings. On the other hand, the same legislation also introduced the concept of qualified opportunity zones, which offer significant tax benefits for investments in designated economically distressed areas. Investors who reinvest capital gains into these zones can defer and potentially reduce their tax liability, while also enjoying tax-free appreciation on their new investments if held for at least 10 years. These evolving tax policies underscore the dynamic nature of real estate taxation and the importance of staying informed about legislative changes. What might be an optimal strategy one year could become less advantageous the next, necessitating a flexible and adaptive approach to real estate tax planning. As we consider the philosophical implications of these tax strategies, it's worth pondering the broader economic impacts. Real estate tax benefits, while advantageous for property owners, also serve a larger economic purpose. They incentivize investment in real property, which can drive economic growth, create jobs in construction and related industries, and potentially revitalize communities through development and improvement of properties. However, these benefits also raise questions of equity and fairness in the tax system. Critics argue that such provisions disproportionately benefit wealthy individuals and large corporations, potentially exacerbating wealth inequality. Proponents, on the other hand, contend that these incentives are necessary to encourage the kind of large-scale investment that drives economic progress. As we look to the future, it's clear that real estate taxation will continue to evolve. Climate change concerns may lead to new tax incentives for energy-efficient buildings or sustainable development practices. The ongoing shift towards remote work could reshape demand for commercial real estate, potentially leading to new tax policies to address changing urban landscapes. Moreover, the increasing sophistication of data analytics and artificial intelligence could revolutionize how properties are valued for tax purposes, potentially leading to more accurate and dynamic assessment methods. This could have far-reaching implications for property taxes, which form a crucial part of many local government budgets. As we transition from the world of real estate tax benefits, we find ourselves naturally drawn to another crucial aspect of long-term financial planning: retirement account optimization. While real estate offers tangible assets and immediate tax benefits, Retirement accounts present a different set of strategies for tax-efficient wealth accumulation. In our next segment, we'll explore how to navigate the complex landscape of retirement taxation, building on the principles of strategic planning and long-term thinking we've discussed in the context of real estate. As we delve deeper into the intricacies of tax optimization, we now turn our attention to a topic that affects nearly every working individual: retirement account optimization. This segment will guide you through the labyrinth of retirement planning strategies, each designed to maximize your tax benefits and secure your financial future. Let's begin by exploring the fundamental dichotomy in retirement accounts: traditional versus Roth. Traditional accounts offer immediate tax deductions, but tax your withdrawals in retirement, while Roth accounts are funded with after-tax dollars, but provide tax-free growth and withdrawals. This simple distinction forms the basis of a complex decision-making process that can significantly impact your long-term financial health. Consider, for a moment, the concept of tax arbitrage across time. By carefully managing your contributions and withdrawals, you can potentially pay taxes when your rate is lowest, effectively reducing your lifetime tax burden. This strategy requires a deep understanding of not only current tax laws, but also projections of future tax rates and your personal income trajectory. Now, let's delve into the nuances of contribution timing strategies. The conventional wisdom of maxing out your retirement accounts as early as possible in the year isn't always optimal. For those with variable income or those anticipating significant life changes, a more measured approach might be beneficial. By strategically timing your contributions, you can potentially maximize employer matches, take advantage of market dips, or align with your cash flow needs. But contribution strategies are just the beginning. The true art of retirement account optimization lies in distribution planning. As we age, our financial needs and tax situations evolve, necessitating a dynamic approach to withdrawals. Consider the concept of tax bracket management. By carefully controlling your taxable income each year, you can potentially remain in lower tax brackets, reducing your overall tax burden. This leads us to a more advanced technique: the Roth conversion ladder. This strategy involves systematically converting traditional IRA funds to Roth IRA funds over several years, potentially allowing you to access retirement funds earlier without penalty while managing your tax liability. However, this technique requires careful planning and consideration of your overall financial picture. Let's now explore the intricacies of required minimum distributions, or RMDs. These mandatory withdrawals from traditional retirement accounts can significantly impact your tax situation in later years. By proactively planning for RMDs, you can potentially reduce their impact through strategies such as qualified charitable distributions or strategic Roth conversions in lower income years. As we delve deeper into advanced rollover techniques, consider the potential benefits of an in-plan Roth conversion within a 401k. This strategy allows you to convert pre-tax funds to Roth funds within the same plan, potentially offering tax advantages and greater control over your retirement savings. However, it's crucial to carefully consider the immediate tax implications and your long-term financial goals before executing such a strategy. Another advanced strategy to consider is the backdoor Roth IRA contribution. For high-income earners who exceed the income limits for direct Roth IRA contributions, this technique involves making a non-deductible contribution to a traditional IRA and then immediately converting it to a Roth IRA. While this can be an effective way to access Roth benefits, it's important to be aware of potential pitfalls, such as the pro rata rule for those with existing traditional IRA balances. As we navigate these complex strategies, it's crucial to maintain a holistic view of your retirement planning. This involves coordinating across multiple accounts, 401ks, IRAs, taxable investment accounts, to create an integrated strategy that optimizes not just for tax efficiency, but also for your overall financial goals and risk tolerance. Now, let's ponder the broader implications of these retirement account optimization strategies. On a societal level, the structure of our retirement system and the associated tax incentives have a profound impact on national savings rates and income distribution in retirement. The ability to defer taxes on retirement savings has been a cornerstone of U.S. retirement policy, aimed at encouraging long-term financial planning. However, this system also raises questions of equity. The progressive nature of our tax system means that higher-income individuals often benefit more from these tax-advantaged accounts. This has led to ongoing debates about the fairness and effectiveness of our current retirement savings incentives. Looking to the future, we must consider how changing demographics and economic conditions might impact retirement policy. As life expectancies increase and traditional pension plans become less common, the importance of individual retirement account optimization grows. Future policy changes could potentially alter the landscape of retirement planning, necessitating adaptable strategies. Moreover, the concept of retirement itself is evolving. With many individuals choosing to work part-time or pursue encore careers in their later years, the traditional model of a full-stop retirement at a set age is becoming less common. This shift may necessitate more flexible approaches to retirement account management, allowing for phased withdrawals and ongoing contributions. As we conclude our exploration of retirement account optimization, consider how these strategies fit into your broader financial picture. Remember, while tax efficiency is important, it should not come at the expense of your overall financial well-being or peace of mind. The goal is to create a retirement plan that not only minimizes your tax burden, but also provides the financial security and flexibility to enjoy your golden years. In our next segment, we'll shift our focus to the global stage, exploring the complex world of international tax planning. As we navigate this terrain, keep in mind how these strategies might integrate with the retirement optimization techniques we've just discussed, creating a comprehensive approach to your financial future. Segment break. As we delve deeper into the intricate world of tax optimization, we now turn our attention to the complex and ever-evolving realm of international tax planning. This fascinating area of taxation bridges the gap between domestic fiscal policies and the global economic landscape, offering both challenges and opportunities for the astute tax strategist. At its core, international tax planning revolves around the fundamental principle of managing tax liabilities across multiple jurisdictions. This concept has roots stretching back to the early days of international trade, when merchants first began grappling with the complexities of conducting business across borders. Today, in our increasingly interconnected world, the importance of understanding and navigating international tax structures has never been more critical. Let's begin our exploration with the cornerstone of international taxation, the foreign tax credit. This mechanism, designed to prevent double taxation, allows taxpayers to claim a credit for taxes paid to foreign governments. Imagine, if you will, a global chess game where each move represents a financial transaction, and each square on the board a different tax jurisdiction. The foreign tax credit acts as a protective shield, ensuring that your chess pieces, your income, aren't captured twice by different tax authorities. Building upon this foundation, we encounter the intricate web of tax treaties. These bilateral agreements between nations serve as the diplomatic channels of the tax world, establishing rules for taxing cross-border activities. Think of tax treaties as carefully negotiated peace accords, harmonizing the tax treatment of income and preventing fiscal conflicts between countries. Each treaty is a unique tapestry, woven with provisions that can significantly impact international tax planning strategies. As we venture further into this labyrinth of international taxation, we encounter the concept of offshore structures. These arrangements, often misunderstood and sometimes vilified in popular media, can serve legitimate purposes in international tax planning. Picture, if you will, a series of interconnected islands, each representing a different jurisdiction with its own unique tax laws. By strategically positioning assets and income streams across these islands, businesses and individuals can optimize their global tax position. However, it's crucial to note that the use of offshore structures requires careful navigation through a sea of complex regulations. The introduction of initiatives like the OECD's Base Erosion and Profit Shifting (BEPS) project has fundamentally altered the international tax landscape. These regulations aim to ensure that profits are taxed where economic activities occur and value is created, adding new layers of complexity to international tax planning. Let's now delve deeper into the intricate world of advanced international tax structures. One such structure is the use of holding companies in tax-favorable jurisdictions. Imagine a towering skyscraper with each floor representing a different entity in the corporate structure. The holding company, situated at the penthouse level, serves as the central hub for managing investments and funneling income in a tax-efficient manner. Another sophisticated technique in the International Tax Planner's toolkit is the strategic use of hybrid entities. These are business structures that are treated differently for tax purposes in different jurisdictions. Picture a chameleon, able to change its appearance based on its environment. Similarly, hybrid entities can adapt their tax classification to optimize the overall tax burden across multiple countries. Transfer pricing, a critical aspect of international tax planning, deserves our attention next. This practice involves setting the price for goods and services exchanged between related entities across borders. Visualize a complex system of pipes and valves, carefully calibrated to ensure that the flow of value between different parts of a multinational enterprise is both economically sound and tax efficient. The art of transfer pricing lies in striking a delicate balance between commercial reality and tax optimization. As we navigate these advanced concepts, it's important to consider the impact of digital taxation. The rise of the digital economy has challenged traditional notions of physical presence and permanent establishment. Imagine a virtual marketplace spanning the globe, where transactions occur in cyberspace rather than in brick-and-mortar establishments. This new paradigm has prompted countries to rethink how they tax digital businesses, leading to the emergence of new rules and potential double taxation risks. Cross-border mergers and acquisitions present another fascinating area of international tax planning. These transactions are like intricate puzzles, where each piece represents a different tax consideration. From structuring the deal to manage withholding taxes, to planning for post-acquisition integration and repatriation of profits, the tax implications of cross-border M&A can be both complex and far-reaching. As we approach the philosophical implications of international tax planning, we must consider its broader impact on global economic systems. The interplay between national sovereignty and international cooperation in tax matters raises profound questions about the nature of governance in our interconnected world. Are we moving towards a more harmonized global tax system, or will national interests continue to shape diverse tax landscapes? Moreover, the ethical dimensions of international tax planning cannot be ignored. Where does legitimate tax planning end and aggressive tax avoidance begin? This question challenges our notions of corporate social responsibility and the social contract between businesses and the societies in which they operate. As tax planners, we must navigate not just legal complexities, but also moral considerations in an increasingly transparent global environment. Looking to the future, the field of international tax planning is likely to undergo significant transformations. The push for greater transparency, exemplified by initiatives like the Common Reporting Standard and country-by-country reporting, is reshaping the landscape of international taxation. Imagine a world where tax information flows as freely as capital across borders, fundamentally altering the dynamics of global tax competition and cooperation. As we conclude our exploration of international tax planning, we're left with a sense of both the immense complexity and the profound importance of this field. In our global economy, understanding and navigating international tax structures is not just a matter of financial optimization, but a crucial aspect of strategic business planning and global economic governance. As we transition to our next topic, estate planning techniques, we carry forward the lessons of international taxation. The principles of cross-border planning and long-term strategic thinking will serve as valuable foundations as we explore how to preserve and transfer wealth across generations. Let us now turn our attention to this equally fascinating and complex area of tax optimization. As we delve deeper into the realm of tax optimization, we arrive at a topic that intertwines financial strategy with the inevitabilities of life: estate planning techniques. This complex area of tax law offers a myriad of opportunities for preserving wealth and minimizing tax burdens across generations. Let's explore the intricate world of trusts, gifts, and generational wealth transfer. At its core, estate planning is about more than just passing on assets. It's a strategic approach to organizing one's financial affairs to maximize the benefits for heirs while minimizing tax liabilities. The foundation of effective estate planning lies in understanding the basic structures available. Trusts, for instance, serve as powerful tools in this arena. A trust is essentially a legal arrangement where assets are held by one party, the trustee, for the benefit of another, the beneficiary. There are various types of trusts, each with its own tax implications. Revocable trusts, for example, offer flexibility as they can be altered during the grantor's lifetime. However, they don't provide significant tax advantages as the assets are still considered part of the grantor's estate. Irrevocable trusts, on the other hand, can offer substantial tax benefits by removing assets from the grantor's taxable estate, but at the cost of relinquishing control over those assets. Gift tax strategies form another crucial component of estate planning. The annual gift tax exclusion allows individuals to give a certain amount per recipient each year without incurring gift tax. For 2023, this amount is $17,000. This strategy can be particularly effective for gradually transferring wealth over time, especially when combined with the lifetime gift tax exemption, which as of 2023 stands at $12.92 million per individual. However, the art of gift giving in estate planning extends beyond mere monetary transfers. Consider the strategy of gifting appreciated assets. By transferring assets that have significantly increased in value, such as stocks or real estate, the donor can potentially avoid capital gains tax on the appreciation, while the recipient receives the asset at its stepped-up basis. As we venture deeper into estate planning techniques, we encounter more sophisticated strategies. One such approach is the use of family limited partnerships, FLPs. FLPs allow families to consolidate their business or investment assets into a single entity, potentially providing both asset protection and tax benefits. The senior generation typically retains control as general partners, while transferring limited partnership interests to younger family members. The tax advantage of FLPs lies in their ability to facilitate the transfer of wealth while potentially applying valuation discounts. Because limited partnership interests lack control and are often not readily marketable, they may be valued at less than their proportionate share of the partnership's assets. This can result in significant gift and estate tax savings when transferring these interests to family members. Another advanced technique in the estate planner's toolkit is the grantor retained annuity trust, or GRAT. This strategy involves transferring assets into a trust while retaining the right to receive an annuity payment for a specified term. If the assets in the trust appreciate at a rate higher than the IRS assumed rate of return, known as the 75/20 rate, the excess growth can pass to beneficiaries free of gift tax. GRATs can be particularly effective in a low interest rate environment or with assets expected to appreciate significantly. However, they require careful planning and execution, as the grantor must survive the trust term for the strategy to be effective. As we navigate through these complex strategies, it's crucial to consider the role of life insurance in estate planning. Properly structured life insurance policies can provide liquidity to pay estate taxes, equalize inheritances among heirs, or fund buy-sell agreements in family businesses. The key is to ensure that the life insurance is held outside of the taxable estate, often through an irrevocable life insurance trust, ILIT. Generation skipping transfer, GST tax planning, is another critical aspect of comprehensive estate planning. The GST tax is designed to prevent wealthy families from avoiding estate taxes by transferring assets directly to grandchildren or more remote descendants. However, there's a GST tax exemption that, when used strategically, can allow for significant wealth transfer to future generations free of transfer taxes. As we contemplate these intricate estate planning techniques, it's important to recognize their broader implications. These strategies don't just impact individual families, They have far-reaching effects on wealth distribution, economic inequality, and even social mobility. The ability to transfer substantial wealth across generations, tax-free, raises questions about the fairness of our tax system and the concentration of wealth in society. Moreover, estate planning techniques often intersect with complex family dynamics. The decisions made in structuring trusts and gifts can have profound effects on familial relationships, sometimes creating tension between the desire for financial optimization and the maintenance of family harmony. This underscores the importance of clear communication and careful consideration of non-financial factors in estate planning. Looking to the future, the landscape of estate planning is likely to evolve. Changes in tax laws, such as potential reductions in estate tax exemptions or modifications to basis step-up rules, could significantly impact current planning strategies. Additionally, the increasing complexity of global assets and digital property presents new challenges and opportunities in estate planning. As we transition from the realm of estate planning, we find ourselves naturally drawn to a related yet distinct area of tax optimization: charitable giving strategies. While estate planning focuses on preserving wealth for future generations, charitable giving offers opportunities to make a lasting impact on society while potentially reaping significant tax benefits. Let's explore how these two areas of financial planning can work in harmony to create a comprehensive legacy strategy. As we drift deeper into the intricacies of tax optimization, we find ourselves at the intersection of financial strategy and social responsibility. Charitable giving strategies offer a unique opportunity to align our fiscal goals with our philanthropic aspirations. This segment will explore the multifaceted world of charitable contributions and their tax implications, providing a soothing journey through the complexities of generosity in the tax code. Let's begin by considering the fundamental principles of charitable giving from a tax perspective. At its core, charitable giving allows taxpayers to deduct contributions made to qualified organizations from their taxable income. This basic concept, however, unfolds into a tapestry of nuanced strategies and considerations. The Internal Revenue Service recognizes various types of charitable contributions, including cash donations, property, and even volunteer expenses. Each category comes with its own set of rules and limitations, creating a complex landscape for the tax-conscious philanthropist to navigate. For instance, cash donations are generally the simplest to document and deduct, while property donations often require professional appraisals and more intricate record-keeping. One of the most straightforward yet powerful tools in the charitable giving arsenal is the donor-advised fund. These funds allow contributors to make a charitable donation, receive an immediate tax deduction, and then recommend grants from the fund over time. This strategy provides flexibility in timing donations for maximum tax benefit, while allowing for thoughtful distribution of funds to various causes over an extended period. Imagine, if you will, a reservoir of goodwill. You fill this reservoir with your charitable intentions, receiving the tax benefits as the water flows in. Then, over time, you can direct streams of support to various causes, watching your initial contribution nourish multiple worthy endeavors. This is the essence of a donor-advised fund, a concept that marries immediate tax planning with long-term philanthropic vision. For those with more substantial charitable aspirations, private foundations offer a more hands-on approach to philanthropy. These entities allow donors to maintain significant control over their charitable assets and grant-making decisions. However, they also come with increased administrative responsibilities and regulatory oversight. The tax implications of private foundations are correspondingly complex, with strict rules governing minimum distributions and limitations on tax deductions. As we delve deeper into the realm of charitable giving strategies, we encounter more sophisticated approaches that blend philanthropy with estate planning and income management. Charitable remainder trusts, for example, allow donors to contribute assets to a trust, receive income from those assets for a specified period, and then direct the remaining assets to a charity upon the trust's termination. This strategy can provide immediate tax deductions, ongoing income, and eventual charitable impact. Consider the concept of a charitable lead trust, which operates in reverse. Here, a charity receives income from the trust for a set period, after which the remaining assets are transferred to non-charitable beneficiaries, often family members. This approach can significantly reduce gift and estate taxes while supporting charitable causes, creating a harmonious balance between family wealth preservation and social responsibility. The timing of charitable contributions can be as crucial as the contributions themselves. Strategic donors often consider bunching their donations, concentrating several years' worth of giving into a single tax year to overcome the standard deduction threshold. This approach, when combined with tools like donor-advised funds, allows for consistent charitable support while maximizing tax benefits in specific years. As we navigate these waters of charitable giving, it's important to remember that the value of certain donations can fluctuate based on the type of asset given. Appreciated securities, for instance, offer a dual benefit. The donor can avoid capital gains tax on the appreciation while still deducting the full fair market value of the donation. This strategy turns potential tax liabilities into charitable impact, a true alchemy of fiscal responsibility and generosity. The landscape of charitable giving is not without its challenges and considerations. The alternative minimum tax, phase-outs of itemized deductions for high-income taxpayers, and limitations on charitable deductions all add layers of complexity to the philanthropic equation. These factors necessitate careful planning and often require the guidance of tax professionals to navigate effectively. As we reflect on the intricate dance between charitable giving and tax strategy, we must consider the broader implications of these practices. On a societal level, tax incentives for charitable giving represent a partnership between government and private philanthropy. This system encourages individuals and corporations to direct resources toward causes they deem worthy, potentially filling gaps in public funding and fostering a culture of giving. However, this system also raises questions about equity and influence. Does the tax structure of charitable giving disproportionately benefit high-income individuals? How does this impact the distribution of philanthropic resources across various causes and communities? These are complex issues that intersect with broader discussions of tax policy, wealth distribution, and social responsibility. Looking to the future, the landscape of charitable giving strategies is likely to evolve alongside changes in tax policy, economic conditions, and societal priorities. We may see increased scrutiny of charitable deductions, changes in the treatment of different types of donations, or new vehicles for philanthropic engagement. The savvy donor will need to stay informed and adaptable, ready to adjust strategies as the terrain shifts. As we conclude our exploration of charitable giving strategies, we're left with a profound appreciation for the interplay between personal generosity, financial planning, and tax optimization. These strategies offer a unique opportunity to align our fiscal goals with our values, creating a ripple effect of positive impact that extends far beyond our individual tax returns. In our next segment, we'll shift our focus to another powerful tool in the tax optimization toolkit: tax loss harvesting. As we transition, consider how the principles of strategic timing and asset selection we've explored in charitable giving might apply to managing investment losses for tax purposes. The symphony of tax planning continues, each strategy building upon the last in a harmonious composition of fiscal efficiency. As we delve deeper into the intricate world of tax optimization, we arrive at a strategy that intertwines the realms of investment and taxation: tax loss harvesting. This concept, while seemingly counterintuitive at first glance, represents a powerful tool in the arsenal of the savvy investor and tax planner alike. At its core, tax loss harvesting suggests that losses in your investment portfolio can be strategically utilized to offset gains, thereby reducing your overall tax burden. To truly understand tax loss harvesting, let's begin with a simple analogy. Imagine you're tending a garden of financial assets. Some plants flourish, representing your gains, while others wither, embodying your losses. Tax loss harvesting is akin to pruning those withered plants, not just to maintain the garden's health, but to use those clippings to nourish and support the growth of your thriving plants. In this financial garden, the act of pruning and repurposing is a delicate dance of timing and strategy. Historically, this concept emerged from the fundamental principle in tax law that allows investors to offset capital gains with capital losses. This provision, rooted in the desire to encourage investment and risk-taking, has evolved into a sophisticated strategy employed by investors across the spectrum, from individual retail investors to large institutional funds. The foundational principle of tax loss harvesting states that by selling securities at a loss, an investor can offset capital gains realized from selling securities at a profit. Any excess losses can then be used to offset up to $3,000 of ordinary income per year, with additional losses carried forward to future tax years. This seemingly simple concept opens up a world of strategic possibilities for the astute investor. Let's explore this further by considering the intricacies of executing a tax loss harvesting strategy. One of the most critical aspects to navigate is the wash sale rule. This rule, implemented to prevent abuse of the tax loss harvesting strategy, prohibits claiming a loss on a security if you purchase the same or a substantially identical security within 30 days before or after the sale. This 61-day window adds a layer of complexity to the strategy, requiring careful planning and often the use of similar but not identical securities to maintain desired market exposure. The execution of tax loss harvesting often involves a delicate balance between maintaining your desired investment allocation and optimizing your tax position. This leads us to several important implications. First, it necessitates a keen understanding of your portfolio's overall structure and performance. Second, it requires a forward-looking approach, anticipating potential gains and losses, not just in the current tax year, but in future years as well. Research has shown that systematic tax loss harvesting can potentially add significant value to a portfolio over time. A study by Parametric Portfolio Associates suggested that tax loss harvesting could add up to 1.5% in additional after-tax returns annually. However, it's crucial to note that the effectiveness of this strategy can vary greatly depending on individual circumstances, market conditions, and the specific implementation approach. Beyond the mechanical aspects of selling losing positions and reinvesting, advanced tax loss harvesting techniques often involve sophisticated algorithms and automated systems. These tools can scan portfolios continuously, identifying loss harvesting opportunities in real time and executing trades to capture these benefits, while maintaining the portfolio's overall risk and return characteristics. Another critical consideration in tax loss harvesting is the concept of cross-security correlation. When selling a security at a loss, investors often seek to replace it with a similar but not identical security to maintain market exposure while avoiding the wash sale rule. This requires a deep understanding of asset correlations and the ability to identify securities that will behave similarly in the market without triggering IRS scrutiny. The timing of tax loss harvesting activities also plays a crucial role in its effectiveness. While many investors focus on harvesting losses at the end of the calendar year, a more proactive approach involves monitoring for opportunities throughout the year. Market volatility, which can occur at any time, often presents prime opportunities for tax loss harvesting. This ongoing vigilance can potentially increase the strategy's effectiveness and provide more flexibility in managing your tax situation. Beyond the theoretical framework and practical implementation, tax loss harvesting challenges our understanding of investment strategy and market efficiency. It raises profound questions about the interplay between tax policy and investment behavior. For instance, does the availability of tax loss harvesting encourage investors to take on more risk, knowing they have a tool to mitigate the tax impact of potential losses? We must consider what this means for overall market dynamics. If a significant portion of investors are engaging in tax loss harvesting, particularly around the same time, such as the end of the tax year, could this lead to increased market volatility or temporary pricing inefficiencies? These questions highlight the complex relationship between individual investment decisions and broader market trends. Furthermore, the practice of tax loss harvesting intersects with debates about tax equity and the structure of the tax system itself. Critics argue that the ability to strategically harvest losses primarily benefits higher income investors who have more complex portfolios and greater capacity to engage in sophisticated tax planning. This raises questions about the fairness of the tax code and whether such strategies contribute to wealth inequality. On the other hand, proponents argue that tax loss harvesting encourages investment and risk-taking, which can drive economic growth and innovation. They contend that the strategy simply allows investors to manage their tax liabilities more efficiently, which is a fundamental right within the bounds of tax law. As we contemplate these profound implications, it's clear that tax loss harvesting is more than just a technical strategy for minimizing taxes. It's a window into the complex interplay between tax policy, investment behavior, and market dynamics. It challenges us to think critically about the role of taxation in shaping economic incentives and the broader societal impacts of investment strategies. Looking to the future, the practice of tax loss harvesting is likely to evolve alongside advancements in technology and potential changes in tax policy. We may see more sophisticated algorithms and artificial intelligence playing a role in optimizing tax loss harvesting strategies. Additionally, as discussions about wealth inequality and tax reform continue, the regulatory landscape surrounding these practices may shift. As we move forward from the intricacies of tax loss harvesting, let's turn our attention to another crucial aspect of tax optimization: business expense strategies. While tax loss harvesting focuses on managing investment losses, business expense optimization delves into the day-to-day financial decisions. that can significantly impact a company's tax liability. This shift takes us from the world of personal investment to the broader landscape of business finance, where every transaction can have tax implications. As we transition from the intricacies of tax loss harvesting, we find ourselves delving into the equally fascinating realm of business expense optimization. This concept, while seemingly straightforward, harbors depths of complexity that can significantly impact a company's financial health and tax liability. Let us embark on this journey through the labyrinth of business expenses, where every decision can ripple through the fabric of an organization's fiscal structure. At its core, business expense optimization is the art and science of maximizing tax deductions while maintaining strict compliance with ever-evolving regulations. It's a delicate balance, one that requires both precision and creativity. Imagine, if you will, a tightrope walker carefully traversing a wire suspended high above the ground. Each step must be calculated, each movement precise. This is the essence of expense optimization, a constant negotiation between aggressive tax strategy and regulatory adherence. Let's begin our exploration with the fundamental principles of expense categorization. The Internal Revenue Service, or IRS, provides guidelines on what constitutes a legitimate business expense. These are costs that are both ordinary and necessary for the operation of your business. But within these broad strokes lies a canvas of interpretive possibility. For instance, an ordinary expense in one industry might be considered extravagant in another. A deep-sea welding company might justify the purchase of a submarine as ordinary, while the same expense for a bakery would raise more than a few eyebrows at the tax office. Timing strategies play a crucial role in expense optimization. The principle of expense recognition dictates when a business can claim a deduction. Generally, expenses are recognized in the year they are incurred. However, there are nuances to this rule that savvy business owners can leverage. For example, the concept of prepaid expenses allows for certain costs to be distributed across multiple tax years. This can be particularly useful for managing taxable income and potentially reducing overall tax liability. Documentation requirements form the bedrock of any solid expense optimization strategy. In the world of business expenses, the adage, "If it's not documented, it didn't happen," rings particularly true. The IRS requires that expenses be substantiated with receipts, invoices, and other supporting documents. But beyond mere compliance, robust documentation serves as a powerful tool for analysis and future planning. It's akin to a captain's log, charting the financial journey of a business through sometimes turbulent fiscal waters. As we delve deeper into the realm of business expense optimization, we encounter more advanced allocation techniques. Consider the case of mixed-use assets, those used for both business and personal purposes. The challenge here lies in accurately apportioning the expense between these two domains. A home office, for for instance, requires careful calculation of the percentage of your home used exclusively for business. This seemingly simple task can become a complex exercise in spatial and temporal analysis. Another advanced technique in the expense optimization toolkit is the strategic timing of major purchases. By understanding the interplay between depreciation rules and your business's projected income, you can make informed decisions about when to acquire significant assets. This might mean accelerating a planned purchase to take advantage of favorable tax treatment in the current year, or delaying it to offset anticipated higher income in the future. The concept of ordinary and necessary expenses, while straightforward in theory, often becomes a gray area in practice. This is where the art of business purpose optimization comes into play. It's not enough for an expense to be merely helpful. It must be appropriate and helpful. The challenge lies in articulating and documenting the business rationale behind each expenditure. This requires a blend of strategic thinking and narrative craftsmanship, weaving each expense into the larger tapestry of your business objectives. As we navigate these complex waters, it's crucial to remember that the goal of expense optimization is not merely to reduce tax liability, but to align your spending with your overall business strategy. Each expense should be viewed through the lens of return on investment. Sometimes, the most tax-efficient option may not be the best choice for long-term business growth. It's a delicate balancing act, requiring both financial acumen and strategic foresight. The philosophical implications of business expense optimization extend far beyond individual companies. On a macro level, these strategies can have significant impacts on business growth and economic efficiency. When businesses are able to reinvest more of their earnings due to optimized expenses, it can lead to increased innovation, job creation, and overall economic vitality. However, this must be balanced against the societal need for tax revenue to fund public services and infrastructure. Moreover, the concept of business expense optimization raises intriguing questions about the nature of value creation in modern economies. In an increasingly digital and service-oriented business landscape, the definition of what constitutes a necessary business expense is continually evolving. As we move further into the realms of remote work, artificial intelligence, and the gig economy, our understanding of business expenses may need to undergo a radical transformation. Looking to the future, we can anticipate continued evolution in expense regulations. As businesses become more global and digital, tax authorities worldwide are grappling with how to fairly and effectively regulate expenses in this new paradigm. We may see a shift towards more principle-based regulations, allowing for greater flexibility in interpretation, but also requiring more sophisticated justification of expenses. The rise of big data and artificial intelligence is likely to revolutionize expense tracking and optimization. Imagine AI systems that can predict optimal expense patterns based on vast datasets of business performance. This could lead to a new era of dynamic expense management, where spending strategies are continually adjusted in real time based on market conditions and business performance. As we conclude our exploration of business expense optimization, we find ourselves at the intersection of finance, strategy, and philosophy. The decisions we make about expenses are not merely accounting entries, but reflections of our business values and long-term vision. In optimizing our expenses, we are in essence crafting the financial narrative of our organizations, one deduction at a time. As we transition from the world of business expenses, let us turn our attention to the realm of alternative investment structures. Here, we will explore how the principles of optimization we've discussed can be applied to more complex and potentially lucrative investment vehicles. The journey through tax efficiency continues, ever more intricate, ever more fascinating. As we drift deeper into the realm of tax optimization, we now turn our attention to the intriguing world of alternative investment structures. These sophisticated financial instruments offer a unique blend of potential returns and tax advantages, making them a fascinating subject for those seeking to maximize their wealth while minimizing their tax burden. At its core, alternative investments encompass a wide range of assets that fall outside the traditional categories of stocks, bonds, and cash. These can include private equity, hedge funds, real estate investment, trusts, REITs, commodities, and even more exotic options like art or cryptocurrency. The allure of these investments lies not only in their potential for high returns, but also in their ability to provide tax efficiency and portfolio diversification. Let's begin our exploration with partnership structures, a common vehicle for many alternative investments. Partnerships, such as limited partnerships, LPs, and limited liability companies, LLCs, offer unique tax advantages through their pass-through nature. This means that the entity itself doesn't pay taxes. Instead, profits and losses flow through to the individual partners, who report their share on their personal tax returns. This structure can be particularly beneficial for high net worth individuals in higher tax brackets. By carefully structuring investments through partnerships, it's possible to defer income recognition, offset gains with losses from other investments, and potentially convert ordinary income into more favorably taxed long-term capital gains. Consider, for example, a private equity investment structured as a limited partnership. As an investor, you might receive your share of the partnership's income as a combination of capital gains, dividends, and interest. This mix of income types can allow for more flexible tax planning compared to a straightforward stock investment that might primarily generate dividends and capital gains. Moving on to real estate investment trusts, or REITs, we find another compelling alternative investment structure with unique tax implications. REITs are companies that own, operate, or finance income-producing real estate. What makes them particularly interesting from a tax perspective is their special tax status. To qualify as a REIT, a company must distribute at least 90% of its taxable income to shareholders annually in the form of dividends. In exchange for meeting this and other requirements, REITs receive favorable tax treatment. They generally don't pay corporate income tax on the earnings they distribute to shareholders. This can result in higher yields for investors compared to traditional corporate stocks. However, the tax treatment of REIT dividends can be complex. While a portion of REIT dividends may be taxed as ordinary income, other portions might qualify for the 20% qualified business income deduction introduced by the Tax Cuts and Jobs Act of 2017. Additionally, some REIT dividends may be classified as return of capital, which isn't immediately taxable, but instead reduces the investor's cost basis in the REIT shares. This complexity in REIT dividend taxation opens up opportunities for sophisticated tax planning. By carefully timing REIT investments and strategically placing them in taxable versus tax-advantaged accounts, investors can optimize their overall tax situation. Let's now delve into the world of private placements, another alternative investment structure with significant tax implications. Private placements refer to the sale of securities to a relatively small number of select investors. These investments are not subject to many of the regulations that govern public offerings, allowing for more flexibility in structuring. From a tax perspective, private placements can offer several advantages. For instance, they may provide opportunities for investors to defer income recognition or to receive preferential tax treatment on certain types of income. Some private placements might be structured to generate losses in early years, which can be used to offset other income while providing the potential for significant gains in later years. However, it's crucial to note that the tax treatment of private placements can be highly complex and may vary significantly depending on the specific structure of the investment. This complexity underscores the importance of working with knowledgeable tax professionals when considering these types of investments. As we move into the deeper analysis of alternative investment structures, it's important to consider the concept of risk management. While these investments can offer significant tax advantages, they often come with higher levels of risk compared to traditional investments. This risk-return trade-off must be carefully weighed against the potential tax benefits. One advanced strategy in this realm is the use of options and derivatives within alternative investment structures. For instance, a hedge fund might use complex options strategies to manage risk, while also creating specific tax outcomes. By carefully timing the exercise of options or the closing of derivative positions, it may be possible to control the timing and character of income recognition for tax purposes. Another sophisticated approach involves the use of offshore investment structures. While these must be approached with caution due to complex international tax rules, they can offer unique opportunities for tax deferral and, in some cases, tax reduction. For example, certain offshore insurance products can allow for tax-deferred growth of investments, potentially for many years. It's worth noting that the use of offshore structures has come under increased scrutiny in recent years, with new reporting requirements and anti-abuse rules being implemented in many jurisdictions. This highlights the ever-evolving nature of tax law and the importance of staying current with regulatory changes when employing advanced investment strategies. As we consider the philosophical implications of alternative investment structures, we must reflect on their broader impact on the financial markets and society as a whole. These sophisticated investment vehicles have fundamentally changed the landscape of wealth management and capital allocation. On one hand, alternative investments have opened up new avenues for capital formation, potentially fueling innovation and economic growth. They allow investors to access opportunities that were once reserved for only the most wealthy and connected individuals or institutions. This democratization of complex investment strategies could be seen as a positive development in the evolution of financial markets. On the other hand, the complexity and sometimes opaque nature of these investments raise questions about market efficiency and fairness. Do these structures create an uneven playing field where those with the resources to access and understand complex investments gain an unfair advantage? And what are the broader economic implications of investment strategies that often prioritize tax efficiency over other factors? Moreover, the rise of alternative investments has implications for tax policy and wealth inequality. As high net worth individuals and institutions increasingly use these structures to minimize their tax burdens, it raises questions about the fairness of the overall tax system. Should tax policy be adjusted to address these sophisticated strategies, or would doing so risk stifling innovation and economic growth? Looking to the future, we can expect continued evolution in the realm of alternative investments. Technological advancements, such as blockchain and artificial intelligence, are likely to give rise to new investment structures with their own unique tax implications. At the same time, regulatory responses to existing strategies will shape the landscape of what's possible and permissible. As we transition from our exploration of alternative investment structures, we find ourselves naturally drawn to the realm of tax credit maximization. While alternative investments offer sophisticated strategies for managing income and capital gains, tax credits provide a different avenue for reducing one's overall tax burden. These two approaches, when combined thoughtfully, can create a powerful synergy in comprehensive tax planning. As we delve deeper into the labyrinth of tax optimization, we arrive at a particularly lucrative junction: tax credit maximization. This strategy, often overlooked in its full potential, offers a direct reduction to your tax liability, making it a powerful tool in the arsenal of any astute tax planner. Let's explore the intricate world of tax credits, where each dollar saved is a dollar earned, quite literally. At its core, a tax credit is a dollar-for-dollar reduction in the amount of tax owed. Unlike deductions, which merely reduce your taxable income, credits directly decrease your tax bill. This fundamental difference makes credits particularly valuable, especially for those in higher tax brackets. Consider, for instance, a $1,000 tax credit. For someone in the 35% tax bracket, this credit is equivalent to a deduction of nearly $2,857. This stark contrast illustrates why understanding and maximizing tax credits is crucial for comprehensive tax planning. Let's begin our exploration with an overview of some common tax credits. The Earned Income Tax Credit, or EITC, is designed to benefit low to moderate income workers. The Child Tax Credit provides relief for families with children. The American Opportunity Tax Credit and Lifetime Learning Credit offer support for education expenses. For businesses, there's the Research and Development Credit, encouraging innovation, and various energy-related credits promoting sustainability. However, the true art of tax credit maximization lies not just in identifying available credits, but in strategically planning to qualify for and optimize them. This requires a deep understanding of the qualification criteria, timing considerations, and potential limitations for each credit. For instance, the EITC has specific income thresholds that vary based on filing status and number of children. A slight increase in income could potentially disqualify you from thousands of dollars in credits. Therefore, careful income planning becomes crucial. Let's delve deeper into the nuances of credit optimization. Take the Child Tax Credit as an example. Recent legislative changes have significantly altered its landscape. Understanding these changes and how they interact with your specific financial situation can lead to substantial tax savings. For some families, it might be beneficial to accelerate or defer income to maximize this credit. Similarly, for education credits, timing your tuition payments can make a significant difference in your credit eligibility from year to year. For businesses, the landscape of tax credits is even more complex and potentially rewarding. The Research and Development Credit, for instance, is not limited to stereotypical lab-based research. Many businesses engage in qualifying activities without realizing it. This could include developing new products, improving manufacturing processes, or even creating new software. The key is in properly documenting these activities and associated expenses. Another area ripe for optimization is energy-related credits. Both individuals and businesses can benefit from credits for solar installations, energy-efficient home improvements, or electric vehicle purchases. These credits not only reduce tax liability, but also align financial interests with environmental sustainability. However, these credits often have phase-out periods or caps, making timing a critical factor in maximization strategies. As we navigate deeper into credit maximization, we encounter more advanced strategies. One such approach is the concept of credit stacking. This involves carefully structuring activities and investments to qualify for multiple credits simultaneously. For instance, a business might engage in research and development activities that not only qualify for the R&D credit, but also align with energy efficiency improvements, potentially qualifying for additional energy credits. Another sophisticated strategy involves the use of pass-through entities to optimize credit utilization. In some cases, credits that might be limited or unusable at the individual level can be more effectively utilized when flowing through a business entity. This requires a careful analysis of the interaction between various credits, income levels, and entity structures. It's crucial to note that while credit maximization can lead to substantial tax savings, it must be approached with caution and expertise. The IRS scrutinizes credit claims closely, and improper claims can lead to audits, penalties, and interest charges. Therefore, maintaining meticulous documentation is paramount. This includes not only financial records, but also contemporaneous logs of activities, especially for credits like the R&D credit, where the nature of the work is as important as the expenses incurred. As we ponder the implications of tax credit maximization, we must consider its broader economic and social impacts. Tax credits are often used as policy tools to incentivize certain behaviors or support specific sectors of the economy. The R&D credit, for instance, is designed to keep the United States competitive in global innovation. Energy credits aim to accelerate the transition to sustainable technologies. Understanding this broader context can help in anticipating future trends in tax credit policies. From a philosophical standpoint, the existence and structure of tax credits raise interesting questions about the role of government in shaping economic behavior. Are tax credits an efficient means of achieving policy goals, or do they unnecessarily complicate the tax code? Do they truly incentivize desired behaviors, or do they simply reward actions that would have occurred anyway? These are complex questions without easy answers, but they form an important part of the ongoing debate about tax policy and economic incentives. Looking to the future, we can anticipate continued evolution in the landscape of tax credits. As societal priorities shift and economic challenges emerge, new credits may be introduced, while others may be phased out or modified. Staying informed about these changes and understanding their potential impact on your tax situation will be crucial for ongoing optimization. In conclusion, tax credit maximization is a powerful strategy that can significantly reduce your tax liability. It requires a combination of knowledge, planning, and careful execution. By understanding the available credits, strategically timing actions to qualify for them, and meticulously documenting your activities, you can harness the full power of tax credits to optimize your overall tax position. As we transition to our next topic, advanced deduction strategies, remember that the true art of tax optimization lies in the synergy between various techniques. Just as we've explored the intricacies of credit maximization, we'll now delve into the equally complex world of deductions, where every detail can make a significant difference in your tax outcome. As we delve deeper into the intricate world of tax optimization, we now turn our attention to advanced deduction strategies. These sophisticated techniques represent the pinnacle of tax planning, offering powerful tools for those who seek to maximize their financial efficiency within the bounds of the law. Let us embark on this journey through the labyrinth of deductions, where each careful step can lead to significant tax savings. At its core, the art of deduction optimization revolves around the meticulous itemization of expenses. This process, far from being a mere accounting exercise, is a delicate balance of timing, documentation, and strategic planning. Imagine, if you will, a master chef carefully selecting ingredients for a gourmet dish. In much the same way, the astute tax planner must choose which deductions to claim and when to claim them for maximum benefit. The foundation of advanced deduction strategies lies in understanding the interplay between various types of deductions and their impact on your overall tax liability. Consider, for instance, the concept of bunching deductions. This technique involves concentrating deductible expenses into a single tax year to surpass the standard deduction threshold, thereby maximizing the benefit of itemization. It's akin to a gardener deciding when to harvest their crops for the most bountiful yield. Let's explore this further with a practical example. Imagine a taxpayer who typically falls just short of the standard deduction limit. By strategically timing charitable contributions, medical expenses, and property tax payments, they could potentially push their itemized deductions well above the standard deduction in alternating years. This rhythmic approach to deduction planning can lead to substantial tax savings over time. However, the true art of deduction optimization extends far beyond simple timing strategies. It encompasses a deep understanding of the tax code's nuances and the ability to navigate its complexities. For instance, consider the interplay between state and local tax, SALT deductions, and the alternative minimum tax, AMT. A savvy tax planner must carefully balance these elements, much like a tightrope walker, maintaining perfect equilibrium. One advanced technique in this realm is the strategic use of donor-advised funds. These vehicles allow taxpayers to make a large charitable contribution in one year, claiming the full deduction immediately, while spreading out the actual charitable gifts over several years. This approach not only maximizes the tax benefit, but also allows for more thoughtful and impactful philanthropy over time. Another sophisticated strategy involves the careful management of medical expenses. While the threshold for deducting medical expenses can be high, those who understand the intricacies of the tax code can often find ways to maximize this deduction. This might involve coordinating major medical procedures or purchases of medical equipment to coincide with years of higher income, thereby increasing the likelihood of surpassing the deduction threshold. As we delve deeper into these advanced strategies, it's crucial to understand the concept of phase-outs. Many deductions and credits begin to phase out as income rises, creating a complex landscape of financial planning. The skilled tax optimizer must navigate this terrain carefully, balancing income recognition with deduction timing to minimize the impact of these phase-outs. Consider, for example, the interplay between retirement account contributions and other deductions. By carefully managing contributions to traditional IRAs or 401(k)s, one can potentially lower their adjusted gross income, thereby preserving eligibility for other valuable deductions and credits that might otherwise be lost due to income limitations. The realm of business deductions offers another layer of complexity and opportunity. For those engaged in self-employment or owning small businesses, the strategic use of home office deductions, vehicle expenses, and depreciation can significantly reduce tax liability. However, these areas are often subject to intense scrutiny, requiring meticulous documentation and a thorough understanding of the applicable rules. As we contemplate these advanced deduction strategies, it's important to consider their broader implications. The tax code, in its essence, is a reflection of societal values and economic policy. Each deduction represents a choice by policymakers to incentivize certain behaviors or support particular sectors of the economy. By engaging in advanced deduction planning, we are, in a sense, participating in a complex economic dance choreographed by legislative intent. This philosophical perspective raises intriguing questions about the nature of taxation and individual financial responsibility. Are we, as taxpayers, obligated to pay the maximum amount possible? Or is it our right to minimize our tax burden within the bounds of the law? How do these advanced strategies impact overall economic efficiency and equity? Looking to the future, we must consider how these deduction strategies might evolve. As technology advances and data analytics become more sophisticated, we may see a shift towards more dynamic and personalized tax planning. Artificial intelligence could potentially analyze countless variables in real time, suggesting optimal deduction strategies tailored to individual financial situations. Moreover, as global economic pressures and changing societal needs influence tax policy, we may witness significant shifts in the deduction landscape. The savvy tax planner must remain vigilant, adapting their strategies to an ever-changing regulatory environment. This constant evolution underscores the importance of ongoing education and professional guidance in the realm of tax optimization. As we conclude our exploration of advanced deduction strategies, we find ourselves standing at the intersection of financial acumen, legal interpretation, and ethical consideration. These techniques, when applied with skill and integrity, can yield significant benefits. However, they also require a deep understanding of the tax code, meticulous record keeping, and often the guidance of experienced professionals. In our next segment, we will turn our gaze towards the horizon, exploring future trends in tax planning and how they might reshape the landscape of financial optimization. As we transition, let us carry forward the insights gained from our journey through advanced deductions, recognizing that in the world of taxation, knowledge truly is power. As we approach the final segment of our journey through tax optimization strategies, we find ourselves at the frontier of future tax planning. This realm of financial foresight not only encapsulates all we've explored, but also propels us into the uncertain, yet exciting landscape of tomorrow's tax environment. The art of future tax planning is akin to navigating a ship through ever-changing waters. Just as a skilled captain must anticipate storms and currents, a savvy tax planner must foresee shifts in legislation, economic trends, and global dynamics. This forward-thinking approach is not merely about predicting changes. It's about crafting flexible strategies that can adapt to various potential scenarios. Let's begin by examining the core principles of future tax planning. At its heart, this discipline revolves around three key elements: trend analysis, scenario planning, and adaptive strategy development. Trend analysis involves studying historical patterns in tax legislation, economic cycles, and political shifts to identify potential future directions. Scenario planning, on the other hand, is the process of envisioning multiple possible futures and preparing for each. Finally, adaptive strategy development focuses on creating flexible plans that can pivot as circumstances change. Consider, for instance, the evolving landscape of digital currencies. A decade ago, few could have predicted the tax implications of cryptocurrency transactions. Yet, those who anticipated the potential for digital assets to become mainstream were better positioned when tax authorities began scrutinizing these transactions. This example underscores the importance of staying ahead of the curve in tax planning. One of the most critical aspects of future tax planning is the ability to anticipate and prepare for policy changes. This requires not just an understanding of current tax laws, but also an awareness of political and economic factors that could influence future legislation. For example, growing concerns about wealth inequality might lead to more progressive tax structures or increased estate taxes. Similarly, environmental concerns could result in new carbon taxes or incentives for green technologies. To illustrate this point, let's imagine a scenario where global efforts to combat climate change lead to the implementation of a comprehensive carbon tax system. Forward-thinking businesses and individuals who have already begun incorporating environmentally friendly practices into their operations and investments may find themselves at a significant advantage. They might not only avoid potential penalties, but also benefit from new tax credits and incentives designed to promote sustainable practices. Another crucial element of future tax planning is technological adaptation. As we've seen in recent years, advancements in technology have dramatically changed how businesses operate and how individuals manage their finances. These changes have profound implications for tax planning. For instance, the rise of remote work has created new challenges and opportunities in terms of state and international taxation. Consider a company that embraces a fully remote workforce. This decision could have far-reaching tax implications, from payroll taxes to nexus considerations for state and local taxes. A forward-thinking tax strategy might involve creating a flexible corporate structure that can adapt to various jurisdictional requirements, potentially leveraging favorable tax treaties or economic incentive programs in different locations. Moreover, the increasing sophistication of data analytics and artificial intelligence is revolutionizing tax planning. These technologies enable more accurate forecasting, real-time tax impact analysis, and even automated compliance processes. Future-oriented tax planners are not just using these tools, they're anticipating how they might reshape the entire landscape of tax administration and compliance. Imagine a world where AI-powered systems can instantly analyze every financial transaction, categorize it for tax purposes, and provide real-time guidance on tax implications. This level of immediacy and accuracy in tax planning could fundamentally change how individuals and businesses approach financial decision-making. However, with these technological advancements come new challenges. The digital economy has blurred traditional notions of physical presence and jurisdiction, leading to complex questions about where value is created and how it should be taxed. International efforts to address these issues, such as the OECD's Base Erosion and Profit Shifting (BPS) project, signal a future where global tax cooperation and standardization may become increasingly prevalent. This potential for increased global tax coordination highlights another critical aspect of future tax planning: the need for a global perspective. As economies become more interconnected, tax strategies that once worked within national borders may become obsolete. Future-oriented planners must think globally, considering not just domestic tax laws, but also international agreements, foreign tax credits, and the potential for harmonized tax systems across regions. For instance, a multinational corporation might need to develop a tax strategy that can adapt to various scenarios, from increased global tax harmonization to a potential fragmentation of international tax agreements. This might involve creating flexible holding company structures, diversifying operations across multiple jurisdictions, or developing robust transfer pricing policies that can withstand scrutiny under various regulatory regimes. But future tax planning isn't just about navigating potential challenges. It's also about seizing opportunities. As governments use tax policy to incentivize certain behaviors or investments, forward-thinking individuals and businesses can position themselves to benefit. This might involve investing in emerging technologies that are likely to receive favorable tax treatment, or structuring business operations to align with anticipated economic incentives. Consider the potential for new tax incentives aimed at promoting sustainable development or addressing social inequalities. A future-oriented tax strategy might involve aligning business practices or investment portfolios with these goals, not just for tax benefits, but as part of a broader strategy for long-term success and sustainability. As we delve deeper into the realm of future tax planning, it's crucial to recognize that this is not a one-time exercise, but an ongoing process of adaptation and refinement. The most effective future tax planners will be those who cultivate a mindset of continuous learning and flexibility. This involves staying informed about emerging trends, building networks with experts across various fields, and regularly reassessing and adjusting strategies. In this context, the concept of risk management takes on new importance. Future tax planning isn't just about minimizing tax liabilities. It's about balancing potential tax benefits against other business and personal objectives, all while navigating an uncertain regulatory landscape. This might involve developing multiple contingency plans, stress testing strategies under various scenarios, and maintaining sufficient flexibility to pivot when necessary. As we approach the conclusion of our exploration into future tax planning, it's worth reflecting on the broader implications of this approach. At its core, effective future tax planning is about more than just financial optimization. It's about creating resilience and adaptability in an ever-changing world. It requires a holistic understanding of not just tax laws, but of economic trends, technological advancements, and societal shifts. In essence, the future of tax planning is intrinsically linked to the future of our global economy and society. As we navigate this complex landscape, the most successful individuals and organizations will be those who can anticipate change, adapt quickly, and align their tax strategies with broader goals of sustainability, social responsibility, and long-term value creation. As we conclude this journey through the intricate world of tax optimization strategies, from basic income shifting to the complexities of future planning, remember that the landscape of taxation is ever evolving. The strategies we've explored are not just tools for financial optimization, but frameworks for understanding and adapting to the changing nature of our economic systems. May this knowledge serve as a foundation for your financial decisions, guiding you through the complex maze of tax planning with wisdom and foresight. As you drift off to sleep, let these concepts percolate in your subconscious, perhaps inspiring new insights and strategies in your waking hours. Thank you for joining us on this extensive exploration of tax optimization strategies. Sleep well, and may your financial future be as optimized as your restful night.